In this video, I finally share my entire portfolio. This is a video I've been promising for a while now, and I've been kind of delaying it because I was thinking that going over all of my stocks in my portfolio, I currently have 35 holdings, would be absolutely tedious and boring for you and for me. But I did promise to show my entire portfolio, and I do want to do it. So the way I'm thinking about structuring this video, I'm not gonna go over every stock. I think that would be more interesting for new subscribers, for people who are watching this channel for the first time. If you're one of them, hi, hello, nice to meet you. But I want this video to be more for people who already kind of follow this channel, and most of the stocks in my portfolio already talked about in the past, and they kind of get already who I am and what am I trying to do. But in this video, I want to kind of piece it all together, where in the past I've talked about my how I began with value slash growth investing, where my performance has been not so great at all, and I feel I've made a lot of beginner investment mistakes, but also some of those stocks I am still holding, and I'm gonna show it today, and also my dividend portfolio, which I have been focusing more on lately, and I have talked a lot about on this channel. So I want to kind of piece it all together and show it all together, how I think about my portfolio currently as a whole, just sharing a little bit of my thoughts, and maybe even like to discuss it and think with you together how satisfied am I currently with my portfolio, and also going forward from here, what's going to be my strategy, what do I think I should do, and mostly what should I do with those growth stocks which I have invested in the past, and they are not doing great at all so far. So I kind of want to share just show my portfolio as a whole and talk about it a little bit. So this is my entire portfolio. I'm just gonna show it all in one and not go one by one. So the way I organized it, I wasn't sure how to, and I'm sure it's still not perfect, but that's what there is for today. I broke the 35 holdings into two columns. This is going from my largest position to my smallest position, and we can see here that for each holding we have the ticker, the name, the percentage of the entire portfolio, and this is my return. As you can see, they're pretty heavy losses here, especially in the blue lines, which we'll talk about in a minute, and it's not always easy to share this. I hope you can appreciate it. I'm sure not a lot of investors online are gonna show their losses as much as their winners also, so I hope you can show your appreciation and be gentle with me. And this is my this column is my price target for the company for 2-3 years. If my investment thesis materializes, this is my price target, and therefore the annualized return that I am expecting from this investment, if my investment thesis does materialize in 2-3 years. Actually, each of this has its own years, but now it's mostly 2-3 years. I used to have 7-10 years, but I realized that's too far away, and you cannot really predict anything for 7-10 years. So this is my price target for 2-3 years, and the annualized return I'm expecting if that price target is reached. I have more columns in my original spreadsheet with the total upside, and so this is a column I kind of look on a lot when I decide what to sell. Also, for example, Bristol Myers has already kind of nearing my price target, and from the current price, the annualized return I am expecting from it is only 8%, and this is including dividends. So I'm getting to a point where I should really research it again. I'm definitely at the point when I should research it again and maybe rotate it to another stock that has more upside, in my opinion. I'm just gonna explain a little bit what we see here, and then I'm gonna begin to digest my portfolio and my strategy and how I think about things going forward, and also about the past. So the blue lines, the blue holdings, are my old stocks, the ones that most of them I have invested circa 2021, maybe a little bit in 2020, maybe a little bit in 2022, but that's mostly. That was a period when I kind of really tried to implement all the teachings of Warren Buffett and value investing, and like buy a good company at a fair value or at a great price also, and holding for the long term. So the blue lines were my attempt at this, and I kind of want in this video to linger more on them and to talk about them again, although I have talked about it in the beginning when I wrapped up this channel, but most of you were not there still. But also kind of the dividend stocks I already talked a lot about, and we know I kind of want to, when I try to think about all of my portfolio together, currently what is really bugging me here are still those blue lines, those old blue lines, which I'm really down on, most of them, as you can see, and I really need to decide, do I still like them? Is there still place in my portfolio for them? Should I try again? I don't know. So I want to discuss that soon. So I'm currently sitting on 30% cash. As I shared in my previous video, I just got a big lump sum of money. I won a medical lawsuit, and I was sitting before that on 15% cash, which was kind of my target, although it is changing, and now I have more. Me and my husband decided we're gonna try to invest that in ETFs, in index funds, which I wasn't invested in for the last few years. So my project for the next few weeks is gonna be to find some ETFs and kind of blend of ETFs that suits us best, and that will allow me to sleep at night calmly also, which is gonna be a challenge probably. So this is the large current cash position, which it wasn't like that 2 weeks ago. Okay, so my largest positions are Canada Goose and the Douglas Dynamics and Alibaba. I do want to discuss them a little bit more and then jump to other topics here on my portfolio. So Canada Goose is my largest position. Is it my favorite current stock? No, and that's a kind of a dissonance I have, and one of the reasons I want to discuss it also, because it's kind of historically is still hanging here. Canada Goose was an investment I made trying to implement the principles of Warren Buffett, where it's kind of was looking for kind of a company that is similar in characteristics to See's Candy style of company, that is kind of small, is growing nicely, has a big following, people love it, very strong brand, it has a pricing power, is an understatement for Canada Goose, and it had, when I invested in it, it had low debt, it has a very solid, back then it had a very solid capital management, I thought so. It really changed since then, but it was kind of a compounding business where it managed to fuel its very high growth at the time with its own cash flow, so kind of investing back into the business. So it had all those principles, and some of them changed since then. Something about the management of the company seems less professional, and mostly it's a direct-to-consumer strategy, which was also part of my investment thesis, that when it finally kicks into gear, there's supposed to be good financial benefits for the company, is kind of not materializing. And also the story of Nike, where they also tried their own direct-to-consumer strategy, which failed miserably, kind of showed me that direct-to-consumer might be not a good strategy overall for fashion brands like Canada Goose and Nike. So yeah, Canada Goose, I promised myself with this and with Douglas Dynamics that I'm gonna wait until the end of this year, until earnings are reported in March, after this winter, because both of those stocks are my winter bet stocks. And one of the reasons that Canada Goose had this very bad recent years, it's just one of many reasons, but is the very weak winters we had for the last couple of years, when there was essentially no snow in probably globally almost, and the winters were pretty warm, so people were buying. Just one of the reasons for Canada Goose, but for Douglas Dynamics, it is the main reason why the stock is down, not one of the two main reasons. And so my thesis with both of them is that eventually, either this winter or next winter, we're gonna get a normal winter again. Maybe it's gonna be a little bit warmer than historical averages, but they will not probably be as hot as they've been for the last 2 years. And I think this winter is already more snowy, at least where I am. So we'll see with them. I'm waiting with both of them to the earnings report to weather the storm of this winter and see how this winter went for both of them. Douglas Dynamics, I will probably still continue on holding even if it takes another year. But with Canada Goose, I think if this winter hasn't been successful and we see that still there is no prospects for growth fueling back, I will at least reduce my position. So Alibaba is my third position. Alibaba, I began to invest in it when it began only to fall at the beginning of all the scandal that there was with Jack Ma and everything. And back then I thought, wow, it's a really high growth company, very solid business, large market share, very high quality kind of company, except that it is in China, of course. So I placed a kind of a moderate position on it. And then as it went even more and more down, I added more and kind of built up a large position on it. And since then it just continued to fall and fall. With Alibaba, I'm actually sleeping really well with it. Of course, there is the big risk with Alibaba is the China thing, and China is experiencing an economic downturn, which might take years now. But I still think Alibaba is a great company. It does face more competition in recent years, but it is a good company with a very strong business and still its own market share, very diversified also, and it has its international operations and its internal in China operations. So I think it's a great company which is trading very still cheaply because the market kind of ran away from it with all the China thing. But eventually I do think that the market is a weighing machine, and that a company like that definitely deserves a higher valuation that it currently has. So I'm still waiting. I think eventually valuations should get back to at least, I don't know, almost twice from where it is right now. So that's Alibaba. I don't know, I'm fine with it. I'm gonna just stay patient with it for another year, 2, 3, whatever it takes, because if it does in 2-3 years reaches it's just a normal valuation that I think it deserves, there is a potential of 32% of annual return from it. So that's Alibaba. So those are my top 3 positions. I'm gonna add to them and Malibu Boats, which is another company I've invested in right around when I invested in Canada Goose. Also, I've researched it very deeply back then, and also I thought I still think so. I haven't researched it in a while. I really need to do another deep dive to see what's going on with the business. I saw a little bit. They lost their biggest distributor. I don't know. But overall, back then, I also thought that it's a great company that has its own growth, very solidly managed, even more so than Canada Goose. Canada Goose is not so solidly managed, honestly. But Malibu Boats is solidly managed, very professional, strategic management, again, strong moat, stronger brands in its own field, very cyclical, as Canada Goose is also. But except that, long term, if you flatten out the business cycle, it's growing really nicely and it should continue doing so. I still think so. So with Malibu Boats and with Canada Goose, I might need to wait until business cycle is kind of flattening out, because although the market seems is amazing right now. When you look at the S&P 500, there are a lot of macro difficulties currently in the market, and a lot of companies are facing these macro difficulties due to inflation and high interest rates and all of that. So Malibu Boats is definitely feeling that also. With Canada Goose and Malibu Boats, I think my timing sucked. I think still those are good companies. I am leaving them in my portfolio currently. I really invested them in the peak of the boom of COVID, and since then they just their price went down. But I think the businesses are fine, they're solid. Of course, there will be years when they manage to grow more. There will be years when they manage to grow less. But overall, I think that long term there are still good businesses to have. I hope that with Canada Goose and Malibu Boats, the story is that I invested in it, and I was really down in the first years, but since then I did really well with them. That's the story I'm aiming for with Malibu Boats and Canada Goose. So with Douglas Dynamics, I did an investment mistake when I invested in it, but from the current price, I think it's a really great value opportunity. Alibaba also, I don't know, maybe I should reduce my position a little bit, because there is the China risk, which will always be there. And of course, if it wasn't for that, everybody would invest in it, and then the price wouldn't be so down. And so I have no certainty of why and when should that resolve itself. Those are my top kind of my older stocks. The other ones are Expel, which it was one of maybe my first value investing. Like it's more growth. It's obviously growth, but a good company for the long term that is growing again, compounding, and it has a very low debt or no debt. I don't even remember. It was really one of the first ones I invested in, and I'm currently up 50% on it after 3 years. But actually, I was up like 200% on it, I think. But since then it has declined. Its growth stopped. Also, I think it's the macro thing. Maybe they're catering to electric vehicles, to EVs. So probably I haven't researched it in a while. Also, this is one stock I said to myself I'm buying and I'm holding forever, and I'm not even checking it every once in a while. I will just leave it there, and it's still hanging there. And I'm not sure that there is an upside from the current price. I'm just holding it for the long term, just as a kind of as an experiment. I actually really like this company when I initially researched it, and the reason their position is lower is because it was just one of my first ones. I kind of began to put larger positions later on, and this is one of my older ones so I still wasn't confident enough to put a large position, and maybe rightfully so, right? So this is Expel, which I am always debating with myself, should I still hold it for the long term, or should I just sell it, because it's kind of from this price I'm not sure there is much of an upside, and call it quits on the whole buy and hold for long term strategy. Mindset, I think that when it was obviously overvalued a few years ago, I should have sold it, and I kind of missed on this opportunity and lost money because of it. So there is this notion that hold forever, whether it's overvalued, whether it's undervalued, and long term you will be well, maybe, but if you sell it when it's overvalued, you can do even better, I think. So when you put this money to work in some place that has more value in it. So this is my constant debate with Expel. When I decide something, I might do a video about it. So this is Expel. I still feel this video is very boring, but you know what? I'm gonna just do it because I promised, and I'm gonna move on to something more interesting to do. So the last two, though this is the juicy, this is gonna be less boring now. The last two blue lines in my portfolio are, ouch, like really hurt to just looking at them, are SolarEdge and Medifast. Two of my absolutely biggest failures, and those were big positions, and I lost my shirt in those two positions, and man, does it hurt to look at them. Sometimes I just want to sell them just to not see them anymore. But yeah, SolarEdge and Medifast, two companies that I also thought at the time that they have a strong brand, which now I understand they they didn't, and they have maybe a moat, which now I understand they didn't at all. And they were very Medifast never had debt. It to this day doesn't have any debt. Solar Edge had low debt. It's not gonna be the case anymore from now on. But they were solidly managed again by managements that I liked. Again, looked like a nice growth as a company for the long term that is compounding and is able to grow and finance its growth and all of that. But they both failed miserably, and I think it's when you're active investor and you're stock picking, it's bound to happen once in a while in your life when the stock you're investing in is basically going to zero and you're losing your whole position. But the fact that it happened twice, out of not there were more stocks that I invested in back then, and I just sold them since then. Some for a profit, some like break even, very little for loss, and because whatever is losing is still here. But the fact that it happened with both SolarEdge and Medifast, where I'm down 34%, 94% on each of them, is kind of, I think that it's not just bad luck. Those were bad choices, and I get it. I know what they were. I think those were both companies where their business was absolutely temporary, and I should have realized that SolarEdge was a part of a huge hype, and when I bought into it, I thought I was buying in a price which was already after the hype burst, but no, it was still not. And since then, of course, it just failed miserably. But I don't know, just investing in solar in the peak of the solar hype, it was such a mistake, and I'm not gonna do that again. And with Medifast, it was such a fad, and I suspected that, and something in me knew that, but I don't know, I was kind of convinced by the good financials of the company, and the fact that it did, before it completely exploded, it did pretty well for like 10 years, so, and it had its very large following and the whole ecosystem of it, and I thought it's going to be sustainable, but it wasn't. And this is my biggest reason for, from now on, looking for companies that with more track record. I think if I would have understand that they don't have enough of track record and that their business is pretty new, I would have understand that it might not be sustainable for the long term. So that's those are the blue lines, the really difficult part of my portfolio to look at and to talk about. So again, the way I think about them moving from forward from now on is that some of those companies, especially the bigger positions, now the bigger positions, because they haven't declined by 94%, I think I just need to be more patient with them, and I still think they're fine companies, maybe not Canada Goose, but the other ones, they're good companies, and my timing really sucked with them. This is what I think. With the SolarEdge and Medifast, I made a huge mistake, and no, it's not about timing. I shouldn't have invested in them. I should have been more smart with them, and I hope I learned my lesson. I'm still holding on to them because it just is such a significant position, I don't care. I mean, I could rotate them to just a small position of a dividend stock, but SolarEdge might recover, and Medifast might, I don't know, it's just so insignificant. I don't want to even waste my CPU power on them. So yeah. So those are the blue lines, which are my oldest stocks. And since then, one of the biggest problems I had then is that I wasn't consistent with researching stocks, and I didn't dedicate enough time. And I was, I was just in the period of my life when I didn't prioritize this. I mean, I strive to be an active investor, but I actually didn't do anything. And so one of the biggest lessons I've learned is that I should be consistent. If I wanted to be an active investor, I should consistently check out stocks. I should consistently research stocks, and I should consistently look at my portfolio and to refresh it and rebalance it, and just to be actively on it, which seems so obvious, but I don't think I realized that enough back then. For me, it was like set it on and forget it, like buy Canada Goose and forget it, buy Solar Edge and forget it, and don't look at the market for 20 years, even if the market is closing for 20 years. Don't look at the price every day. So that was my mindset then. But I realized it just made me not work hard enough to build my portfolio even. So what I have been doing for the last 5 months was dividend investing. As if you've been following this channel, you know where the yellow holdings are my dividend stocks, where I try to buy dividend companies when I think they have a little bit of an upside or there is an opportunity for a swing. So it's not really an upside in its fair valuation, but the price swings around certain ranges, and I'm kind of betting for it to continue to swing. If not, that's still okay. I'm still holding a good company for the long term. So those are the yellow lines, and I've talked about most of them on this channel. I'm not gonna go over them. What I will mention is that Bristol Myers and UGI corporations were my biggest bets, and they're most up, and I'm really happy about it. So I can see that if I'm looking at my returns currently from the dividend portion. First of all, the stocks that I want you to note that stocks that are already appreciating price, I'm selling them. They're reaching my target price, and I'm selling them. So the reason that that we see a lot of stocks here are down is because I'm still waiting for them to reach my fair valuation. Also, food stocks really pulled down in recent weeks. So it kind of looks bad now. But overall, I am satisfied with this portion, and I'm very optimistic about it because, again, my biggest positions are up with Bristol Myers and UGI, which are not high quality companies, but they were so undervalued, which I thought they were no-brainer. And it's very nice to see the validation that hopefully it's not just a coincidence, and it's just not just a lucky guess that I was right. And also with I don't know, nothing surprises me here, maybe except essential. It is just 10%. It's not really significant. With realty income, I knew it could go down, but overall, I feel like my portfolio is really stable currently. And the stocks that is most down for me are the ones that I put a small position in. In Hershey's, I actually initially decided not to invest. I checked it out, and I decided it was still too expensive. With the option of earnings flattening. Now they're going down, but if earnings are going to be flat, the valuation probably will revert a little bit back to normal valuation. And I decided at first not to invest in it, and then I don't know, I looked at it again and kind of impulsively put a small position in it, and it's down since then 15%. I might now add more and build a larger position in it because it's mostly the prices of cocoa, from what I understand, that are affecting it, and of course they will eventually normalize as any commodity, and it's still a very good company, although okay, I don't want to analyze the Hershey's now. So that's it pretty much. What didn't I mention? I'm gonna talk about these pale green lines which are not fitting in any strategy. Norwegian Cruise Lines, I actually invested not so long ago. It was just 2-3 months ago, and I'm up 50% on it. It's not a dividend stock. I am currently focusing on dividend stocks, but I just kind of checked it out, and I really liked it. It seemed like kind of a no-brainer. So I decided to just put a medium position in it, and I'm really glad that it worked out well so far. And I have Café de Coral, which is a really weird one. It's a cafe chain in Hong Kong. I actually got this idea from the Value Investing Club website, which I'm always planning to dig more there. And I kind of try to research it as much as I can, but again, it's Hong Kong. How confident can I be with my knowledge in it? So it looks very good, but I put a small position in it. It's actually one of my theses when I invested in it was that the dividend was cut, and since then it was reinstated, so now it's my yield on cost, it's like 7% only for the dividend for this company. So even if the price does not appreciate, the dividend is really, really sweet. So that's Cafe de Coral, but I don't know a lot about it. It's in Hong Kong, so I just put a small position in. I mean, I know a lot about the company, but not about the environment it operates in. So I put a small position in it. I also have a few CEFs. Just when I kind of read and learned about CEFs, I decided to dabble in them a little bit. So that's my overall portfolio. So the way I am thinking about it going forward from now on is that I will continue to focus on my dividend strategy, which I really like. I think it's going well. Again, if I take into account the stocks I already sold, my returns are pretty nice so far, which I did promise I'm begin to track my performance and will share it here, hopefully in a more interesting video. So those are my dividend stocks. And with the blue ones, my older stocks that I'm still holding, I'm gonna decide case by case, but again, with Canada Goose and Douglas Dynamics, I'm gonna wait until March to see the report of this year. Alibaba, I might reduce the position, but I think I'm still gonna wait for it in another 1-2 years. I think it eventually should really appreciate in price. That's my opinion. I haven't researched it in a while though, maybe I should. Malibu boats I will definitely be still holding for now, but I should research it again and then maybe then it's not gonna be so definitely. XPEL, as I said, I need to decide if I want to hold forever or when it doesn't have enough of an upside from current price I should sell, and that's it. And except that I'm gonna keep focusing on my dividend strategy, and I'm gonna allocate this new cash I've got to some ETFs. I'm gonna try to find something I feel comfortable with, and I should decide, and that's another project I have for now, what is my stance on value investing, because I feel that if things are not as simple as I learned, and I'm kind of learning it the hard way. I've lost a lot of money and it hurts a lot, and I wanna kind of figure out whether I got all the right info, but I missed something, or something in the basic assumptions, the underlying assumptions of value investing is completely flawed, and I'm really curious to find the answer for myself on those questions, and that's something I'm gonna do a deep dive and kind of open this Pandora box and begin to try to answer some questions on it. That's just a little bit some pies of my current asset allocation. I'm 30% in cash. The dividend stocks are currently around half of my portfolio again after I got this cash, but it was actually more before. And the growth/value, my old, are here, 18%. This is the allocation by sector. So as you can see, still a large portion of my portfolio, again, excluding this new cash I just got, is in consumer cyclical, which is highly cyclical companies. And that's why I've been kind of trying to avoid dividend stocks, as I mentioned a few times on this channel, that are cyclical. I was kind of looking for more defensive stocks. So if we look here, we have the pharma, which are not so cyclical. They have their own risks, of course, but Amdocs and a lot of food stocks, some tobacco stocks, some utilities. So really something more defensive in a case of a recession. But lately, as this portion of my portfolio began to exceed the 50%, I began to be willing to invest in more cyclical dividend stocks. So those are genuine parts, for example. And I had something more. What was that? Pernod Ricard, I've still undecided. It's officially classified as consumer defensive, but I think it's pretty cyclical also. So that's it. That's my portfolio. I promised. I showed it. I didn't promise I would make it interesting, right? What I will do in the next few weeks is again search for an ETF, and I have a few stocks to analyze, and we'll see whatever comes my way. So yeah, well, man, I hope nobody watched this video. Bye bye.